Let me guess how your investing journey probably started. You downloaded a trading app, watched a few YouTube videos, saw someone turn $5,000 into $200,000 trading stocks, and you thought, okay, I can probably do that too. So you bought your first stock. It went up 4%. You felt like a genius. Then the next one dropped 8%. Then you panic sold. Then it recovered without you. And suddenly investing feels less like building wealth and more like emotional damage. If that sounds familiar, here's the uncomfortable truth. Most people trying to beat the market are doing the exact opposite of what actually works, because the strategy that beats about 90% of traders looks unbelievably boring. No constant trading, no watching charts, no trying to predict crashes, just buying and waiting. And strangely enough, that strategy quietly crushes most professionals. But before we explain it, you need to understand why so many smart investors lose money. Look, humans are wired for action. If your car breaks down, you fix it. If you're losing a game, you change strategy. But the stock market punishes that instinct. The more decisions you make, the worse your results usually get. And there's actual data proving this. According to the Spiva scorecard, which compares professional fund managers to the market, about 85 to 90% of active funds fail to beat the S&P 500 over long periods. These are people with Ivy League degrees, teams of analysts, complex algorithms, and they still lose to a simple index. Imagine entering a race where 90% of professional runners lose to someone casually jogging with headphones. That's basically the stock market. But it gets worse. A large study of retail day traders found that only about 1% consistently make profits. 1%. That means if you put 100 traders in a room, 99 eventually lose, and yet millions of people keep trying. Why? Because trading feels productive. Buying and selling makes you feel like you're doing something smart. But investing is one of the rare areas in life where doing less often produces better results. Think of it like planting a tree. You plant the seed, you water it, then you leave it alone. If you dig it up every week to check the roots, you kill the tree. And that's exactly what most investors do. They buy, they check the price, they panic, they sell, they repeat. Every time they interfere, they damage long-term growth. So what is this lazy strategy that beats most traders? It's called index investing, and the idea is ridiculously simple. Instead of trying to pick the next winning company, you buy the entire market. For example, the S&P 500 includes 500 of the largest companies in the United States: Apple, Microsoft, Amazon, Nvidia, Google, and hundreds more. When you buy an S&P 500 index fund, you're buying a tiny piece of all of them. Instead of betting on one horse, you own the entire race. Now here's where it gets interesting. Over the past century, the US stock market has returned roughly 10% per year on average. That might not sound exciting, but compounding turns that into something crazy. Let's do simple math. If you invest $500 a month, starting at age 25, and earn about 10% annually, by age 65, you could end up with over $1 million. No stock picking, no trading, just consistency. And yet most investors never reach this outcome. Not because the strategy doesn't work, but because they interrupt it. They panic during crashes. They chase hype stocks. They jump between strategies. Every time they reset the compounding machine. And there's a famous example that proves this. In the 1980s, legendary investor Peter Lynch ran one of the best performing mutual funds in history. It averaged about 29% annual returns. Insane performance. But when Fidelity later looked at investor accounts, they found something shocking. The average investor in the fund actually lost money. How is that possible? Because people kept buying after big gains and selling after drops. They turned a winning fund into a losing investment. That's the psychology problem. Investing isn't a knowledge game, it's a behavior game, and markets constantly test your emotions. When prices go up, people feel greedy. When prices drop, people feel panic. And those emotions lead to terrible timing. The lazy strategy removes most of that. Instead of reacting to the market, you follow a system. You invest regularly, you ignore noise, you let time work. Even Warren Buffett recommends this approach for most people. In fact, Buffett once made a $1 million bet. He claimed a simple S&P 500 index fund would beat a group of hedge funds over 10 years. These hedge funds used complicated strategies: short selling, leverage, quant models. After a decade, the index fund won, easily. The hedge funds averaged about 2.2% per year. The index fund returned about 7% annually. And that difference mostly came down to one hidden killer: fees. Every time money moves in the financial world, someone takes a cut. Active funds charge management fees, traders pay spreads, investors pay taxes, and small percentages destroy long-term returns. Here's a simple example. Investor A earns 10% annually. Investor B earns 8% after fees. Over 40 years, Investor A can end up with almost double the wealth, just from a 2% difference. That's why index funds are powerful. Most charge extremely low fees. sometimes 0.03% per year, meaning almost all the growth stays in your pocket. Now here's another interesting advantage. The market constantly upgrades itself. Weak companies fade away, strong companies take their place. 20 years ago, the biggest companies looked completely different. Today, it's dominated by tech giants. The index automatically adapts. It's like owning a sports team that constantly replaces weak players with stronger ones without you doing anything. That's the lazy advantage. But there's one moment where most investors fail. Market crashes, because they will happen. The dot-com crash in 2000, the financial crisis in 2008, the COVID crash in 2020. During these periods, the market can fall 30% to 50%. And that's when emotions take over. People panic sell. They wait for things to feel safe again. But by the time things feel safe, prices are already higher. Historically, every major crash has eventually recovered and reached new highs. The investors who stayed invested benefited from the rebound. The investors who exited locked in losses. Think of crashes like turbulence during a flight. It feels terrifying, but the plane is still heading to the destination. Long-term investors stay seated. Traders run down the aisle, screaming. So how do you actually apply the lazy strategy? Step 1. Invest consistently. Instead of trying to guess market timing, invest on a schedule, monthly, automatically. This is called dollar cost averaging. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it smooths out volatility. Step 2. Keep fees low. Choose broad index funds with minimal expense ratios. Tiny differences in cost become huge over decades. Step 3. Diversify. Many investors combine U.S. stocks, international stocks, and sometimes bonds. Diversification reduces risk and smooths long-term growth. Step 4. Ignore financial noise. News headlines are designed to trigger emotion. Market crash coming. This stock will explode. Sell everything. Most of it is useless for long-term investors. Successful investors think in decades, not days. And finally, automate everything. Automatic investing removes decision-making, which removes emotional mistakes. Because the biggest threat to your portfolio usually isn't the market, it's you. The investors who win long-term aren't the smartest. They aren't the fastest. They aren't the ones making the most trades. They're the ones who stay consistent, who ignore noise, who let compounding do its job. And that's the weird secret. The strategy that beats most traders. Looks lazy. No excitement. No constant decisions. Just patience. But over time, it works like a snowball rolling downhill. Small at first, then bigger, then unstoppable. So if you remember one thing from this video, remember this. The stock market doesn't reward activity. It rewards discipline. And sometimes, the smartest investment move you can make is doing absolutely nothing.